Hello everyone, this video will introduce you to the accounting cycle during the accounting period. The accounting cycle is the process of identifying, analyzing, recording, and communicating the accounting events of a company. During this class, the accounting cycle is studied in two parts. The first part deals with transactions occurring each and every day during the period. The period could be a day, a month, a quarter, or a full year. The transactions taking place are referred to as external transactions because they are between the company and a separate economic entity, like customers, suppliers, vendors, creditors, investors, and other outsiders. The second part of the accounting cycle deals with internal transactions or events needing updating within the company to ensure the accuracy of all data. Internal transactions do not involve two parties, and they are the focus of Chapter 3. Businesses must analyze their transactions to understand how they are affecting their assets, their liabilities, and their stockholders' equity. As they analyze transactions, they must also record each one. The key new term for you in this chapter is double entry accounting. All business transactions that are analyzed and recorded have at least two effects on a company's financial position, and these effects are recorded in at least two accounts. That's what we mean by double entry accounting. All transactions are analyzed to determine their effect on the accounting equation of assets equal liabilities plus stockholders' equity. The system is designed to make certain that the accounting equation is always in balance. Transactions also must be recorded in the books of the company. The transactions are first recorded in a journal. That's why the journal is called the Book of Original Entry. The journal entries are in chronological order so that the business managers know what happened each day. The goal is to have the data organized so that you can make good decisions. The transactions are recorded in journals using debits and credits. Each transaction has a debit entry and a credit entry. It's important that you realize that accounting uses debits and credits to maintain an orderly, systematic, and accurate method for recording transactions. To ensure consistency of recording the information, all companies maintain a chart of accounts. The chart of account is a listing of all the accounts used by the company and their classifications. You will learn that in accounting, the word debit means left or left side, and credit means right or right side, and that's it. Transactions involving assets, liabilities, stockholders' equity, revenues, or expenses will be recorded using debits and credits. This is something you'll need to memorize. The acronym DEALOR, DEALOR, will help you here. DEA stands for dividends, expenses, and assets. Any DEA account increases on its debit side and decreases on its credit side. LOR stands for liabilities, owner's equities, and revenues. Any LOR account increases on its credit side and decreases on its debit side. This is what we'll use to record transactions. For every transaction, it is important to realize that debits will always equal credits. If you're confused at this point, don't worry. By the time the chapter ends, you'll feel confident in what you are doing. For all businesses, the accounting cycle starts with a financial transaction that has to be analyzed and recorded or journalized. Once those transactions are journalized, the amounts are posted to the general ledger. The general ledger is designed to further organize the data by listing and summarizing the activity in each of the company's accounts. The general ledger looks like a T account with the left side and the right side. The left side is the debit side and the right side is the credit side. When entries from the journal are recorded in the general ledger, we call that posting to the ledger. Posting to each account lets us review the activity in each account and determine the account balances. Once all the journal entries are posted to the general ledger, we prepare a trial balance. The sole purpose of the trial balance is to prove that debits equal credits. If debits don't equal credits, something is wrong. The trial balance will list all of the company accounts. Asset accounts will come first, followed by liability accounts, then stockholders' equity accounts, revenue accounts, and expense accounts. All the amounts will come directly from the ending balance of the general ledger. Once the columns are totaled, the debit amounts must equal the credit amounts. Again, if not, there's a mistake somewhere. That's it. That's what this chapter is all about. The accounting cycle starts with transactions, followed by analysis and journalizing, followed by posting to the general ledger, and then summarized with the trial balance. Using the double entry accounting system helps businesses maintain an orderly, systematic, and accurate recording of all financial transactions, enabling them to generate reliable financial statements and make informed decisions. There are two key equations that you must understand. For every transaction that takes place, one, assets have to equal liabilities plus stockholders' equity. The accounting equation must be in balance. And two, for every transaction journalized and posted to the ledger, debits must equal credits. Thank you for taking time to watch this video. Good luck.